As the real estate company Zillow closes its doors on its business unit that buys and sells homes, Zillow Offers, Opendoor's shares surged by 21% in the third quarter. Tiernan Ray has been keeping an eye on both of these stories for us. Tiernan, tell us about Zillow's struggles, but Opendoor's success.
Beth, it's a tale of two realtors. A week ago, Zillow said they're getting out of the business of giving people cash offers for their homes because they just can't make it work. This week, we saw Opendoor, a younger company that has also been making cash offers, have its stock surge by 21% after they beat expectations, saying they're doing great in the market for buying people's homes. One operation can't make the forecasting work, saying they can't deal, Zillow can't deal with the unpredictability of the housing market. The other one, Opendoor, saying we have no problem at all. We're just riding this raging market, moving into new markets, expanding within our existing markets to buying more and more homes.
In this day and age, with the way that the market is, do we know what the difference between these two companies are, their business model? How is one closing its doors and one just outperforming its expected numbers?
It seems that there are two factors at work, Beth. The obvious factor is both of these companies, Zillow and Opendoor, both thought that they could use mathematical models to predict if they bought a home for a certain price from an owner, could they turn around and sell it at a marginal profit? And if they could do this enough times, they could, on a large number of homes, even at a low margin, make a decent amount of money. We saw Zillow say that forecasting is just too unpredictable. In particular, the surge in demand for housing that has driven up prices means that in some cases, Zillow was buying homes that they would not necessarily be able to turn around and sell at a profit. In fact, they're taking write-downs of hundreds of millions of dollars on the inventories of homes that they have to clear. So Zillow said that the unpredictability of forecasting is too much of a problem. Opendoor said, we're very good at this. We know how to do this. We get more and more people to take our cash offers. In fact, while Zillow said they were only able to get 10% of people with a home who went looking for an offer from Zillow to accept Zillow's offer, in fact, Opendoor got 30% or better of people who wanted to sell their homes to take Opendoor's offer. So one story is Opendoor just seems to have better technology. We've interviewed Opendoor's head of data analysis here at ZDNet about the company's technologies in deep learning forms of artificial intelligence. So it is entirely possible that Opendoor has built a better mousetrap using machine learning, using deep learning, using AI, using data analysis than had Zillow. That's one side of the story. However, there's another thing that people don't pay as much attention to, and that is money. It takes a lot of borrowing if you're going to go into a market and just start buying up homes with the intention of later selling them. You have to front the money. So the CEO of Zillow, Richard Barton, had expressed in this letter to shareholders a week ago that it was not just the issue of forecasting. He said, it's going to take a lot of money to do this. The short-term borrowing costs for Zillow had already ballooned from under $1 billion in Q2 in the June quarter to $2.6 billion in the September quarter. Not all of that is home price purchases, but a lot of it is, perhaps the majority. So Zillow was up against, are we going to go borrow more and more and more and more money? Interestingly, Opendoor, company that went public this year through what's called special purpose acquisition company. This is a shell company that goes and finds an existing company and buys it so that that existing company can then come to the public markets. This is what happened is a SPAC went out, found Opendoor, it was this private company, said they've got a great business, we'll buy them. And then through this reverse merger, we'll take them public. So Opendoor came public with a huge amount of borrowed money, debt capital, to add to its funding so it could go out and buy more houses. And since that IPO this year, Opendoor has gone back into the debt markets, issued more debts, more IOU, picked up more money, and they're also able to go and tap the equity markets to sell some of their stock and raise even more money. So even more than forecasting, even more than fancy technology, Beth, at the end of the day, what you may need is a huge pile of money if your proposition is you're just going to go and make sure you give an offer to every person who wants to sell their home.
It always comes down to a business plan, and also typically comes down to how much money and time you're willing to invest into something. Tiernan, thank you so much for reporting on this story. For more things tech, be sure to stick with ZDNet. Thanks for watching.